First and foremost, I'd like to introduce myself. My name is Professor Milligan. I want to welcome you to Ask Professor Milligan. I've got several people here today that are going to ask me some wonderful questions on investing. We're going to get at it. The goal here again is to make money in the marketplace.
So as a first-time investor, what would be sort of like the best way to get exposed to the stock market?
You start looking right in your own backyard. Look at the products and services that you use on a daily basis, products and services that you like, that you spend money on. That's the first place I would look to invest in those type of companies.
On social media, I get bombarded with people that have all kinds of crazy ideas about investing. And, my question for you is where do I start? I hear people talking about how they hit it big in crypto or Forex or stocks or ETFs or even, getting into IPOs. Where do I start and how do I filter out the bad advice?
Before you can actually win the game, you got to know the rules of the game. One, you got to develop some type of investment strategies, strategies that will make you money in different market environments. From those strategies, what you'll end up doing is you'll develop your own personality. Once you develop that, the next thing to do is, believe it or not, go out into the community and find like-minded investors. Look forward, be forward-looking. You want to look for a company that has strong growth in earnings, strong growth in revenue. What that's telling you is that that industry, that company seems to be doing well because of the growth. So one of the keys is what's going to drive the growth in this company going forward. What's the catalyst? What's the energy that's going to push this thing higher? And that's where you're looking to make your money.
In the short term, one of the things that piqued my interest was you talked about protecting your cash. And one of the ways I was told to do that was to invest in ETFs and not individual stocks. Can you talk a little bit about that and whether or not that's a good idea for a young investor trying to diversify his portfolio without taking on too much risk?
If you're not going to be actively involved in the market, if you're not going to be actively involved in picking your stocks, then an ETF is a great way to go. Again, you guys are young, time is on your side. My contention is you just keep putting money into an ETF. If you're not going to actively trade, go do your job, put the money in the ETF and let the ETF work for you.
My question was, is it better to invest in individual stocks versus mutual funds?
If you have the time to do some research, get involved in a network where you're getting some really good ideas, then you could trade. If you don't have the time to actually do it, then mutual funds are a safe way to actually do that, invest. The key to long-term generational wealth in the stock market is foregoing the benefits of the money today for the benefits of the money in the future.
My question, okay, what do you think about stop losses?
Every investor I talk to has a reason why they buy the stock. And my first question to them is, what's your sell strategy? How do you know when to get out? How do you get out? When do you know you're wrong? Stop losses is not really a sell strategy. All right, a stop loss is nothing more than a way that you can actually let your broker know, look, I can't watch this stock all day. I'm going to put a stop loss and then go about my business. If you look at any successful investor trader in any marketplace, the one thing that they all have in common, they all have some type of strategy to handle them to the downside. Their sell strategy, their risk strategy. Stop loss, just a technique to get out of the stock.
I've heard people say, stay away from IPOs. By the time it hits the market, all the upside is gone. I've heard people say, get into IPOs. What do you know about it, and how should I lens IPOs as an investor?
First and foremost, one, you and I cannot get a hot IPO. All right, we just can't get it. And the reason being is because the hot IPOs are dominated by institutional investors. So by the time that stock does make it to the marketplace, the institutional investors are the ones that got it. So our only opportunity really is to buy that IPO once it hits the secondary market. In other words, Once it starts trading New York Stock Exchange or NASDAQ, then you and I can buy it. So when I was running my hedge fund, I was at that time, because of the size of the fund and what I was doing, I was able to get both IPO stock. As competition came from institutions, my IPO, the allotment I was getting smaller and smaller. But here's what happened. In trading those IPOs, I made a lot of money flipping the IPO, which means I got the IPO stock and flipped it and sold it and moved on to the next one. I'm a big proponent in going back and analyzing all your trades, looking at what you did right, what you did wrong. I went one weekend and analyzed all my IPO trades. We looked at every one of them. And here's what I noticed. I noticed that on several of those IPOs, that I had gotten at $10 or $12, whatever the case, and sold it up 20, 30, 40%, moved on to the next one and said, wow, what a great trade. Only to go back and look and study and found out that several of those stocks went from 10, 20 to 60, 70, $100 a share. And I was not there. So at that point I said, okay, time to go back and readjust, time to go back and study this. So in my studying of IPOs, I started forming some strategies. Every one of the great companies that are out there right now, if you think about the FANGs, Facebook, Alphabet, Netflix, Google, Microsoft, think about those companies, every one of them started out as an IPO. Every one of them. And what they did was, there was so much more movement after the initial public offering. So what I typically do is, I track these companies let me back up. I look at these companies internally. I literally dig into the prospectus, and I have a 6-point criteria I run through and look at these companies. What I'm looking for is, when I go through and look, I am looking for the next Microsoft. I am looking for the next Google, the next Alphabet, the next Facebook. So I'll go through and read this prospectus. There's certain key points I look for. Then once a stock goes public, I watch it trade. And I look for opportunities to actually enter the trade when they get long the stock. Now, the other thing about IPOs, which is really interesting, is I can't give you the exact numbers because I don't remember them, but the majority of IPOs aren't around after 3 years, 2 to 3 years. They don't make it. So what I'm saying to you also is, not only can you make money on IPOs that go up, but you can also make money on IPOs that go down. So I've made a tremendous amount of money shorting IPOs. And I'll give you two I just recently talked about was ADT. ADT went public at 14, I believe they started out at $17, $18 a share. Then they lowered the offering price and went public at $14 a share, and it hasn't seen $14 since it went public. All right, went straight down. It was a great short. Casper Sleep, another one. They started talking about Casper Sleep at, I believe it was a price range of 18, 20. They kept long it. They finally priced it. Stock has never seen the IPO price. From the day it opened, it's done nothing but go straight down. Not all IPOs are going to be successful. So your friends are right that give me advice that stay away from them. Well, you can make money on the short side, but you can also make money on the long side.
Shorting the stocks. There's some extra expenses, if I know correctly, for when you short, because you borrow it and short it. So can you describe more of these expenses, or any way to avoid them?
Well, there's no way to really avoid the expenses. The real major expense, additional expense, is that you're basically borrowing money from the brokerage firm. So that loan, excuse me, that you're actually getting from the brokerage firm to actually go on margin, they're going to charge you interest. Now, the good news, though, is that interest is prorated. And what that means is that if you're only in the stock, short the stock for 2 or 3 days, then you're only paying interest for 2 or 3 days. If I'm going to take on the risk, I want the reward. So when you're shorting, one, yeah, there's interest expense, but interest expense is not going to be that much. But two is, everything is predicated on how far down can that stock go. If you're shorting a stock and interest expense is going to be a problem for you in the short position, and odds are you shouldn't have been short in the first place.
I'm a Tesla stockholder.
Okay.
I got in about 3 years ago.
Okay.
and I got in when it was trading around 300 a share prior to the split.
Okay.
So I've been holding it. I haven't touched it. I haven't traded any of it.
Okay.
It's just been steaming.
Okay.
What should I do? Should I sell some of it? Should I keep all of it? What do you suggest is the best way to proceed with Tesla?
Based on what you told me, you're a long-term investor in Tesla. You've owned the stock for several years. So your cost basis is significantly lower than where the stock is now. My advice is hold. Give it room now. No one can sell a stock at the ultimate high. Don't think you're going to sell your Tesla at the high whenever you do get out. You got in line to go to the concert and you're in the front of the line. Why would you get out of line now before it's time to go in and then end up in the back of the line? You're in a great spot, so stay there. Give the stock time to work, the company to work. I don't want to scare you guys. I want you guys to be active in the market, but let me be the first one to tell you, you're going to be wrong and you're going to have some stocks that you buy that are going to go down. It's the nature of the beast. So the sooner you can handle sooner you understand how to handle being wrong will increase your opportunities of being right when you do make money. So in closing, I want to thank all you guys for coming to Ask Professor Milligan. I really enjoy this. You make me think, you make me grow. And the other thing I'm going to say to you is I expect to hear back from you and you tell me how much money you're making, how you took this advice and how you made money from it. Again, don't get it wrong. My goal in Ask Professor Milligan is to help you make money in the stock market. That's my goal. All right. So as you guys go out and make money in the stock market, please come back and tell me your success stories. Share it with us.